We got a supersized rate cut from the Federal Reserve, 50 basis points. So are there supersized gains ahead for tech? Joining us now is Dan Niles. He's the founder of Niles Investment Management. Dan, good to see you. So the Fed didn't cut at the last meeting. That felt like a close call at the time. And then we had these revisions in the jobs numbers, which Powell mentioned. How much do you think that factored into 50 basis points now, and should people be alarmed?
No, I don't think people need to be alarmed at all. It really comes down to why is the Fed cutting? And that's really simple. You've got CPI and PCE both at 2.5%. And before today, you had Fed funds rate at 5.25 to 5.5. If you believe that the Fed's fund rate should be somewhere near the vicinity of wherever inflation is, plus let's say 1%, then you're talking about Fed's funds rate to be quote unquote neutral, should be right around 2.5 to 3.5, and at 5.25, you've obviously got a lot of room to move. So I'm not sort of I put out something earlier today. I'm not caught up on whether it's 25 or 50. You're still going to end up at the same place, barring obviously a recession, which I don't think we're going to get, given the job picture looks pretty solid, and we can get into that, or inflation just reignites, which I do have a concern on much further out, but not currently.
So specifically on tech here, big tech doesn't need to borrow money to operate, but their customers, a lot of them do, and smaller tech does. What's the impact of lower rates on tech?
Well, I think on a relative basis, smaller companies have more floating rate debt. So those companies will do better. So stuff in the Russell. Also, when rates are up at 5%, that's a lot different picture in terms of how attractive a 3% dividend yield looks versus if the Fed's trying to get to 3%. So I think big tech, and we've been writing about this since I think July 11th, our view was you were going to have some fundamental issues with big tech, which you did when they reported results. Let's not forget, big tech is down because Microsoft forward estimates went down after they reported. Google forward estimates went down after they reported. Amazon's forward estimates went down after they reported. That's why big tech is struggling. But other names where these rate cuts are really going to help them, that'll start to perform better. And so, as we've been saying for a while, that's where we're looking. And if you look at it very simply, July 16th was the last S&P 500, peak. Since then, the Magnificent Seven are down 6%. The S&P is down about 1%. But the equal weighted S&P, those other 493 stocks, they're up 3%. And that's including the hit they're taking from those seven. So I think that's the playbook through year end. And you have another earnings season coming up. And so we'll have to see, okay, do earnings for the big tech companies go up, or do some of them continue to go down, in which case you've got a much bigger problem on your hands.
And certainly you've been on this show, even in recent weeks, and you've basically said, look at the other 493 names in the S&P 500. What sectors specifically are catching your attention right now? And perhaps just as importantly, given the fact that we saw yields actually move higher on this move by the Fed today, is that just the market digesting here, or is there a real possibility that you could continue to see that play out as the market now worries about the possibility of inflation?
Yeah, it's to me, it's just a one-day move. I'm not thinking about it because what was the market doing before this? Yields were just going down because people were thinking we might get 50. What was the stock market doing before this? It was going straight up because we thought we were going to get 50. And so what did it do once we got the news? It's buy the rumor, sell the news. It did the exact opposite. So it's not going to surprise me if that reverses tomorrow. But you might have different leadership, which is what I'm more focused on. And ultimately, Fed rate cuts play into stock prices in two ways, right? They support earnings because you got lower borrowing costs. So that's the E. And then it supports multiples because rates are lower. So that supports, you put those two things together, higher PE possible, higher earnings possible, stock market should be up. But the ones you want to maybe go look at are the ones that benefit when rates go from 5% all the way to an endpoint of closer to 3%. And so that's what we're thinking through, especially when you combine it with valuations. Because, I mean, you can always make an argument that tech looks cheap if you look out far enough. But there's no way on absolute terms you can look at some of these growth rates and say that tech is cheap. And so from that angle, a lot of these other sectors that everybody's forgotten about, ever since AI has been in a 24/7 news cycle for about 2 years, those sectors may be ones that people pay more attention to, and therefore the valuations start to move higher in this.